This training equips financial professionals with essential skills to combat money laundering and terrorist financing. Participants will learn to identify money laundering and terrorist financing stages, understand regulatory frameworks, and implement compliance programs. The course also covers customer due diligence and enhanced due diligence procedures, ensuring participants can effectively report suspicious activities. Participants will gain a comprehensive understanding of anti-money laundering and counter-terrorism financing obligations, including the global impact of money laundering and terrorist financing. They will learn to identify stages and methods, articulate regulatory frameworks, build effective compliance programs, apply due diligence principles, and report suspicious activities accurately and promptly. Non-compliance with anti-money laundering and counter-terrorism financing obligations can lead to severe legal, financial, and reputational damage. A robust ethical culture is crucial for effective compliance. Stay vigilant against emerging risks like technology-enabled financial crime and virtual assets. Understanding these trends ensures resilience and adaptability in the ever-evolving anti-money laundering and counter-terrorism financing landscape. Money laundering involves cycling criminal proceeds through financial systems until they seem lawful. This process is crucial for criminals to use or invest their gains, and financial institutions facilitating it risk severe legal and reputational consequences. Money laundering disguises illegal funds' origins, making them appear legitimate. It's a multi-stage process obscuring the link between crime and wealth. Criminal proceeds from activities like drug trafficking and fraud are cycled through financial systems to emerge as lawful funds. Effective laundering is crucial for criminals to use or invest their gains, implicating financial institutions in legal risks. Money laundering unfolds in 3 stages: placement, layering, and integration. Placement introduces illicit cash into the financial system. Layering obscures the origin through complex transactions. Integration reintroduces funds as legitimate assets. Each stage has unique red flags and detection opportunities, necessitating robust anti-money laundering controls to counteract exploitation at any point. Placement is the initial stage where illicit cash enters the financial system, posing the highest detection risk. Techniques include smurfing, where large sums are split into smaller deposits, and using cash-intensive businesses to mix illicit funds with legitimate revenue. Currency exchange is also employed to convert cash into foreign currency or prepaid cards, bypassing banking controls. Layering involves creating a complex web of financial transactions to obscure the origin of illicit funds. This includes routing money through shell companies and offshore structures, executing complex wire transfers, and converting funds into high-value assets like real estate or cryptocurrency. These methods make tracing the audit trail extremely challenging for investigators. Integration is the final stage where laundered funds seamlessly blend into the legitimate economy. Launderers invest in real estate, businesses, or luxury goods, making detection challenging. Common methods include reselling properties, investing in equities, and falsifying loan repayments, all giving the funds a lawful appearance. Money launderers adapt to exploit regulatory gaps and new technologies. Trade-based money laundering involves manipulating trade invoices to transfer illicit value. Real estate laundering uses illicit funds to buy properties, reselling for clean gains. Virtual asset exploitation obscures ownership via cryptocurrencies. Loan-back schemes involve self-loaning laundered funds, creating a legitimate wealth appearance. Terrorist financing involves the provision or movement of funds to support terrorist acts, distinct from money laundering, which conceals illegal origins. Funds for terrorism can be legitimate, sourced from employment or donations. Key characteristics include small, unremarkable transactions, often through charities or informal networks, with intent and destination being critical concerns. Money laundering, ML, focuses on concealing illegal funds' origins, while terrorist financing, TF, concerns the intended use of funds, which may be legitimate. Misunderstanding these differences results in ineffective controls. Compliance professionals must tailor detection strategies to address each threat's unique characteristics, ensuring robust financial crime prevention. Terrorist financing sources are diverse, often camouflaged as legitimate activities. Charitable abuse involves diverting donations from trusted organizations. State sponsorship uses diplomatic channels to obscure links. Virtual assets and crowdfunding bypass banking scrutiny. Self-financing involves personal income or petty crime, often below reporting thresholds. Robust monitoring and analytics are essential for detection. Sanctions are crucial tools for restricting financial activities of entities linked to terrorism and security threats. The Office of Foreign Assets Control in the United States enforces sanctions via the specially designated Nationals List. The United Nations Security Council's lists are binding on member states. The European Union and United Kingdom's Office of Financial Sanctions Implementation have autonomous regimes with specific penalties and licensing frameworks. Regulated entities must screen customers, counterparties, and transactions against sanctions lists. This includes onboarding new customers, ongoing checks on existing ones, and scrutinizing beneficial owners. Upon a match, freeze assets, avoid tipping off parties, report to authorities, and document actions. Seek licenses for legitimate transactions potentially affected. Money laundering and terrorist financing destabilize economies and corrode democratic institutions. They fund global violence, making robust anti-money laundering and counter-terrorism financing compliance a moral and civic duty. This wider context underscores the importance of stringent measures beyond regulatory obligations, highlighting the profound impact on global stability and security. Money laundering and terrorist financing inflict systemic economic damage. Annually, $800 billion to $2 trillion is laundered, equivalent to 5% of global gross domestic product. This distorts markets and displaces legitimate investments. Alarmingly, less than 1% of these funds are seized, highlighting enforcement challenges and the long-term structural damage inflicted on economies. Money laundering and terrorist financing extend beyond economic impacts, deeply affecting social and political structures. They empower criminal networks, enabling further crimes like drug trafficking and corruption. Illicit funds infiltrate governance, distorting policies and eroding democratic accountability. Terrorist financing fuels violence, causing human suffering and political instability, while laundered funds exacerbate social inequality by distorting markets and concentrating wealth. Reputational damage from anti-money laundering, counter-terrorism financing failures can devastate financial institutions. A cycle begins with regulatory investigations, leading to public enforcement actions and loss of client trust. This can result in severe fines, criminal prosecutions, and loss of banking relationships, ultimately threatening the institution's survival and market access. Financial institutions are pivotal in combating financial crime, acting as gatekeepers to prevent illicit access through customer verification and risk assessment. They must monitor transactions for suspicious patterns and report them via suspicious activity reports to financial intelligence units. Collaboration with regulators and law enforcement enhances the effectiveness of anti-money laundering and counter-terrorist financing efforts. In conclusion, money laundering involves placement, layering, and integration, each posing unique risks. Effective controls must target all stages. Terrorist financing differs by focusing on fund use, not origin, necessitating distinct controls. The global impact of financial crime is systemic, distorting economies and funding violence. Financial institutions, as gatekeepers, are crucial in safeguarding the financial system's integrity. This module includes a comprehensive overview of the international standards, national regulations, and enforcement mechanisms that form the backbone of the global anti-money laundering and counter-terrorist financing architecture. Participants would also be equipped with the foundational knowledge needed to navigate both supranational frameworks and domestic regulatory obligations. The global anti-money laundering and counter-terrorist financing framework is supported by international standards and bodies like the Financial Action Task Force, United Nations Conventions, Basel Committee on Banking Supervision, and the Egmont Group. These organizations set benchmarks, coordinate intelligence, and ensure jurisdictions adhere to anti-money laundering and counter-terrorist financing obligations. Their mandates are crucial for professionals navigating cross-border regulatory landscapes. The Financial Action Task Force, established by the Group of Seven in 1989, is pivotal in setting global anti-money laundering and counter-terrorism financing standards. Its mandate includes promoting effective legal and regulatory measures. The 40 recommendations form a comprehensive framework for combating financial crimes. Mutual evaluations assess compliance, influencing international reputation significantly. The Financial Action Task Force's public listing process is crucial for signaling risk levels in jurisdictions. The grey list involves increased monitoring, requiring jurisdictions to address anti-money laundering and counter-terrorism financing deficiencies. Financial institutions must apply heightened due diligence. The black list, or call for action list, includes high-risk countries like North Korea and Iran, demanding strict countermeasures and enhanced due diligence. The Financial Action Task Force's 40 recommendations are structured into thematic pillars, creating a comprehensive anti-money laundering counter-terrorism financing control system. These pillars cover legal frameworks, preventive measures, financial transparency, and international cooperation. Each pillar supports the others, ensuring a cohesive national framework essential for effective implementation rather than isolated efforts. The United Nations laid the groundwork for anti-money laundering counter-terrorism financing with key conventions. The 1988 Vienna Convention mandated criminalizing drug-related money laundering. The 2000 Palermo Convention expanded this to all serious crimes, enhancing corporate transparency and international cooperation. The 1999 Terrorist Financing Convention focused on criminalizing terrorism financing, highlighting the distinction between anti-money laundering and counter-terrorism financing efforts. The Basel Committee on Banking Supervision, hosted by the Bank for International Settlements, translates international anti-money laundering and counter-terrorism financing principles into supervisory expectations for banks. It comprises central banks and supervisory authorities from 28 jurisdictions. Key contributions include guidance on risk management, customer due diligence, and integrating anti-money laundering and counter-terrorism financing risk into the supervisory review process, influencing global regulatory frameworks. The Egmont Group, formed in 1995, is a global network of financial intelligence units, FIUs, facilitating secure financial intelligence exchange. The Egmont Secure Web allows rapid, confidential data sharing, crucial for tracking illicit funds. With over 170 members, it ensures high standards and offers training to enhance financial intelligence unit capabilities, especially in developing regions. International bodies collaborate to create a cohesive anti-money laundering and counter-terrorism financing framework. Their interconnected mandates ensure a robust system of standards, oversight, and intelligence sharing. This synergy enhances global efforts to combat financial crimes, providing a comprehensive approach that strengthens the effectiveness of national and international regulatory measures. National regulatory landscapes transform international standards into enforceable laws. The United States, United Kingdom, Singapore, and Australia exemplify robust anti-money laundering and counter-terrorism financing frameworks. Each jurisdiction's financial intelligence unit plays a pivotal role in implementing these standards, ensuring compliance and enhancing global financial security. The United States anti-money laundering counter-terrorism financing regime is anchored by the Bank Secrecy Act and the USA Patriot Act. The Bank Secrecy Act mandates financial institutions to aid in money laundering detection through record-keeping and reporting. The USA Patriot Act expanded these requirements, focusing on terrorist financing and enhancing information sharing. The Anti-Money Laundering Act of 2020 modernized the framework with beneficial ownership reporting and whistleblower incentives. FinCEN, a bureau of the United States Department of the Treasury, plays a pivotal role in anti-money laundering and counter-terrorism financing efforts. It issues Bank Secrecy Act regulations, administers the Beneficial Ownership Registry, and maintains information sharing frameworks. FinCEN also collects and disseminates financial intelligence, collaborating with agencies like the Federal Bureau of Investigation and Internal Revenue Service Criminal Investigation, and participates in international exchanges through the Egmont Group. The United Kingdom's anti-money laundering counter-terrorism financing framework is anchored by the Proceeds of Crime Act 2002 and the Money Laundering Regulations 2017. The Proceeds of Crime Act outlines key money laundering offences and establishes the Suspicious Activity Report regime. The money laundering regulations enforce European Union anti-money laundering directives, requiring customer due diligence, enhanced due diligence, and firm registration. The Terrorism Act 2000 and Counter-Terrorism Act 2008 address counter-terrorism financing offences, empowering Her Majesty's Treasury to enforce enhanced measures. The Financial Conduct Authority supervises United Kingdom financial services firms' anti-money laundering and counter-terrorist financing compliance. It uses a risk-based model, conducting thematic and skilled person reviews. Key enforcement themes include governance failures, deficient customer due diligence, and inadequate transaction monitoring. The United Kingdom's National Crime Agency processes suspicious activity reports, with over 901,000 submitted in 2022-23. Singapore's anti-money laundering counter-terrorism financing framework is robust, with the Monetary Authority of Singapore overseeing compliance. The Corruption, Drug Trafficking and Other Serious Crimes Act mandates reporting suspicious activities to the Suspicious Transaction Reporting Office. The Terrorism, Suppression of Financing Act aligns with international standards, while Monetary Authority of Singapore notices and guidelines provide sector-specific anti-money laundering and counter-terrorism financing requirements and best practices. Australia's anti-money laundering and counter-terrorism financing regime, led by the Australian Transaction Reports and Analysis Centre, is robust, with the Australian Transaction Reports and Analysis Centre serving as both regulator and financial intelligence unit. The Anti-Money Laundering and Counter-Terrorism Financing Act 2006 mandates obligations for financial institutions, including customer identification and transaction monitoring. The Australian Transaction Reports and Analysis Centre enforces compliance and analyses financial intelligence, with notable penalties against Westpac and Commonwealth Bank of Australia, highlighting its enforcement strength. Key anti-money laundering counter-terrorism financing frameworks across major jurisdictions share core obligations due to Financial Action Task Force's influence. In the United States, the Bank Secrecy Act and Anti-Money Laundering Act are pivotal, with Financial Crimes Enforcement Network as the regulator. The United Kingdom relies on the Proceeds of Crime Act, overseen by Financial Conduct Authority and United Kingdom Financial Intelligence Unit. Singapore's framework involves corruption, drug trafficking and other serious crimes, Confiscation of Benefits Act and Monetary Authority of Singapore, while Australia is governed by Australian Transaction Reports and Analysis Centre. The Financial Intelligence Unit is pivotal in anti-money laundering and counter-terrorism financing frameworks, acting as the central hub for receiving, processing, analysing, and disseminating financial intelligence. Its effectiveness hinges on the quality and volume of reports from regulated firms. Inadequate suspicious activity reports can create significant blind spots, compromising the system's integrity and effectiveness. Financial intelligence units vary globally, with models like administrative, law enforcement, judicial, and hybrid. Administrative financial intelligence units, such as the Financial Crimes Enforcement Network, analyze and filter reports without law enforcement powers. Law enforcement financial intelligence units, like the Australian Transaction Reports and Analysis Centre, integrate financial and criminal intelligence. Judicial financial intelligence units link intelligence with legal proceedings. Hybrid financial intelligence units, like the United Kingdom Financial Intelligence Unit, blend analytical and operational functions. The Suspicious Activity Report, SAR, is crucial for financial intelligence. It is triggered by suspicion of money laundering, unusual transactions, or links to sanctioned entities. Quality over quantity is key. A well-crafted suspicious activity report includes detailed customer identification, nature of activity, reasoning, and context. This ensures effective contribution to national efforts. Non-compliance with anti-money laundering, counter-terrorism financing obligations results in severe penalties for institutions and individuals. Regulators globally are imposing significant fines, underscoring the critical importance of financial crime compliance. This trend highlights the existential risk for firms failing to adhere to these regulations, emphasizing the need for robust compliance frameworks. The escalation of anti-money laundering, counter-terrorism financing penalties is evident in recent years. HSBC faced a $1.9 billion penalty in 2012 for money laundering. Goldman Sachs settled for $3.9 billion in 2020 due to the One Malaysia Development Berhad scandal. Westpac incurred a $1.3 billion fine for 23 million breaches. Binance $4.3 billion penalty in 2023 highlights enforcement in cryptocurrency. Regulators wield a diverse enforcement arsenal against institutions breaching anti-money laundering, counter-terrorism financing obligations. Civil monetary penalties are prevalent, with fines reflecting the severity and management's role. Deferred prosecution agreements, common in the United States and United Kingdom, suspend charges for penalties and remediation. License restrictions or revocations can cripple firms, while independent monitorships impose costly compliance oversight. Individual accountability in anti-money laundering, counter-terrorism financing enforcement is intensifying. Executives and compliance officers face personal criminal prosecution for failures. In the United Kingdom, Proceeds of Crime Act criminalizes non-disclosure of suspicions, while in the United States, Willful Bank Secrecy Act violations can lead to imprisonment and fines. Civil penalties and prohibition orders further underscore the personal risks for senior managers and compliance officers. The Money Laundering Reporting Officer, MLRO, faces significant personal liability. Under United Kingdom Poker S.331, failing to disclose a suspicious activity report, SAR, can lead to 5 years imprisonment. Tipping off or informing a customer about an investigation is also a criminal offence. The MLRO's role under the Financial Conduct Authority's senior managers and certification regime includes personal fines and prohibitions for non-compliance. Anti-money laundering and counter-terrorism financing failures extend beyond fines, causing severe reputational and operational risks. High-profile enforcement actions lead to media scrutiny, customer loss, and share price decline. Poor anti-money laundering counter-terrorism financing records risk losing correspondent banking, isolating firms from global markets. Regulatory remediation consumes resources, disrupts operations, and hampers growth, with effects lasting long after initial issues are resolved. Anti-money laundering, counter-terrorism financing enforcement risks escalate from initial supervisory findings to severe penalties if not promptly addressed. Institutions face cumulative consequences, including fines, reputational damage, and operational disruptions. Effective compliance programs are crucial to mitigate these risks and prevent escalation along the enforcement spectrum. The Westpac case highlights systemic anti-money laundering and counter-terrorism financing failures, with over 23 million alleged contraventions and inadequate due diligence. Consequences included a $1.3 billion penalty, executive resignations, and reputational damage. This underscores that anti-money laundering, counter-terrorism financing failures are governance issues with severe human impacts, not just technical compliance lapses. A weak compliance culture is often the root cause of anti-money laundering, counter-terrorism financing failures. Treating financial crime risk as a mere cost undermines obligations. Senior leadership must champion compliance visibly. Adequate resources and empowerment are crucial, ensuring money laundering reporting officers can escalate issues. Continuous, engaging training fosters a robust compliance culture, empowering staff to understand and act on their obligations. Understanding the global and national anti-money laundering and counter-terrorism financing framework is crucial. Financial Action Task Force, United Nations Conventions, and Basel Committee on Banking Supervision Guidance set universal standards, influencing national laws. Compliance professionals must grasp specific local regulations, as non-compliance leads to severe consequences like fines and reputational damage. A robust compliance culture, supported by leadership, is essential for meeting obligations effectively. Module 3 explores the foundational pillars that ensure regulatory compliance, a risk-based approach, governance and internal controls, and continuous training and awareness. The risk-based approach is pivotal in anti-money laundering and counter-terrorism financing frameworks. It prioritizes resources and scrutiny on genuine threats, avoiding uniform controls for all. This ensures institutions act proportionately, efficiently, and effectively, focusing on areas with the highest risk. The risk-based approach, RBA, mandates institutions to identify and assess money laundering and terrorist financing risks, applying appropriate controls. Endorsed by the Financial Action Task Force, it ensures resources focus on high-risk areas, enhancing due diligence and protecting the financial system without unnecessary expenditure on low-risk relationships. Implementing a credible risk-based approach, RBA, is a continuous process. Institutions must systematically identify threats, document vulnerabilities, and translate assessments into practical controls. The stages identify risks, assess and score, design controls, monitor and review are interconnected, ensuring dynamic adaptation to evolving business and threat landscapes. A thorough risk assessment must address 5 dimensions of money laundering and terrorist financing risk: customer, product and service, geographic, and delivery channel risks. Ignoring any dimension can create vulnerabilities. Consider client profiles, product complexities, geographic exposure, and delivery methods to mitigate these risks effectively. Customer risk assessment is complex, needing initial due diligence and ongoing review. Institutions must apply clear, consistent risk rating criteria. Politically exposed persons pose high corruption risk, requiring enhanced due diligence. Cash-intensive businesses need source of funds verification. Non-resident customers from high-risk areas demand extra scrutiny and justification. Financial institutions must assess the anti-money laundering, counter-terrorism financing risk of each product and service. High-risk products include private banking, correspondent banking, and virtual assets. Key risk factors are anonymity, transaction speed, cross-border reach, and product complexity. Evaluate these to mitigate misuse potential effectively. Geographic risk is crucial in assessing anti-money laundering and counter-terrorism financing threats. Institutions should use a geographic risk framework referencing Financial Action Task Force lists, corruption indices, and sanctions exposure. Countries on Financial Action Task Force's grey or black lists, high corruption indices, and weak anti-money laundering regimes pose significant risks, necessitating enhanced scrutiny and real-time screening. Delivery channel risk impacts identity verification and detection of suspicious behavior. Face-to-face interactions pose the lowest risk, while digital channels require strong electronic verification. Intermediaries present the highest risk, necessitating strict contractual obligations and regular audits of their anti-money laundering controls. A risk matrix is essential for translating risk assessments into actionable ratings. It includes risk categories, indicators, weightings, and a scoring methodology. Best practices involve calibrating weightings, annual reviews, documenting exceptions, and aligning with a business-wide risk assessment. Senior management must approve the methodology. Institutions must match controls to risk tiers. For low-risk profiles, standard customer due diligence and periodic review suffice. Medium risk requires enhanced customer due diligence and escalated monitoring. High risk demands enhanced due diligence, senior management approval, and intensive monitoring. Controls should be robust yet not overly burdensome, ensuring they address risks effectively without hindering business operations. The risk-based approach is a dynamic, evolving process. It involves identifying, assessing, mitigating, and regularly reviewing risks. This ensures that controls remain proportionate and effective, adapting to changes in the business and threat environment. Effective anti-money laundering, counter-terrorism financing compliance is achieved through intentional governance architecture. Boards, senior management, and compliance officers establish structures, accountability, and controls to ensure compliance is actively practiced, not just documented. The board and senior management hold ultimate responsibility for anti-money laundering and counter-terrorism financing compliance. They must set a clear compliance culture, approve the money laundering, terrorism financing risk appetite, and ensure oversight. Senior management should actively engage with anti-money laundering and counter-terrorism financing performance data, challenging and interrogating reports to maintain robust compliance. Boards must actively engage in anti-money laundering and counter-terrorism financing matters. They should approve and review policies, risk assessments, and allocate resources. Oversight includes monitoring key information, reviewing audit outcomes, and ensuring remediation of deficiencies. Boards must also approve compliance framework changes and stay informed on regulatory trends. Institutions must appoint a money laundering reporting officer, MLRO, or anti-money laundering compliance officer, AMLCO, with authority, independence, and anti-money laundering and counter-terrorism financing expertise. This role requires direct board access and independence from revenue functions. Regulatory approval is essential and personal liability is common. A qualified deputy ensures continuity and compliance during transitions. The money laundering reporting officer plays a crucial role in managing legal obligations, operational risks, and business enablement. Key responsibilities include handling internal suspicious activity reports, owning and updating anti-money laundering counter-terrorism financing policies, overseeing staff training, and liaising with regulators and law enforcement. These tasks ensure compliance and effective risk management within the organization. The Money Laundering Reporting Officer's annual report is crucial for governance, detailing suspicious activity report volumes, customer due diligence and enhanced due diligence activities, training, audits, and risks. It must be candid, highlighting concerns and resource needs. The board must formally acknowledge and respond, ensuring actions are tracked to completion. A robust anti-money laundering and counter-terrorism financing framework relies on clear, current, and accessible documentation. Policies outline the what and why, procedures detail the how, and controls specify the when and by whom. This structure ensures strategic intent translates into effective daily operations. Regulators demand anti-money laundering and counter-terrorism financing documentation to be comprehensive and operationally embedded. Policies must address risk appetite, regulatory obligations, and compliance roles. Procedures should cover customer due diligence, beneficial ownership verification, and internal reporting. Ensure confidentiality, maintain records, and define review frequency to meet these requirements. The 3 lines of defense model is crucial for managing anti-money laundering and counter-terrorism financing risk. The first line involves business operations managing risk daily. The second line, compliance and risk, offers oversight and guidance. The third line, internal audit, provides assurance to the board, ensuring the effectiveness of the first 2 lines. Independent audit is crucial for anti-money laundering and counter-terrorism financing compliance, providing objective assurance to the board. The audit scope includes policy adequacy, customer due diligence, enhanced due diligence effectiveness, transaction monitoring, suspicious activity report handling, training, and money laundering reporting officer function. Auditors must be independent, with full access to records. Audits should occur annually or when significant changes or anomalies arise. Audit findings must drive genuine remediation. Prioritize by severity, assigning timelines and escalating critical issues to the board. Assign ownership to individuals, not teams. Track progress with a live action log, escalating overdue items. Validate closure independently. Self-certification is insufficient for high-severity findings. Strong governance is essential for compliance. It ensures accountability, transparency, and responsiveness. Without it, systemic failures are inevitable. Clear responsibilities, honest information, and prompt action are crucial for effective governance. Employee training and awareness are crucial for effective compliance. Without knowledgeable, confident, and motivated staff, even the best risk frameworks and governance structures will falter. Training is the human infrastructure essential for the success of any compliance program. Anti-money laundering, counter-terrorism financing training is a legal requirement globally, mandated by Financial Action Task Force Recommendation 18. Regulators examine if training is provided to all relevant staff, updated with current legislation, tailored to roles, and if completion records are maintained. Effectiveness is assessed beyond mere completion to ensure compliance and avoid penalties. Anti-money laundering, counter-terrorism financing training must be ongoing to adapt to evolving financial crime landscapes. Annual refreshers ensure staff are updated on regulatory changes. Trigger-based training addresses new products or geographies. New joiners receive immediate training, and effectiveness is reviewed through testing and scenario exercises, with follow-ups for weak performance. Tailored anti-money laundering and counter-terrorism financing training is crucial. Board members need strategic insights and governance knowledge. The Money Laundering Reporting Officer team requires deep technical expertise. Frontline staff focus on customer due diligence and red flags. Relationship managers balance compliance with commercial duties. Information technology and operations ensure data integrity and system controls. Each role demands specific, relevant training methods. Effective role-based training begins with mapping each role to specific anti-money laundering and counter-terrorism financing risks. Use real scenarios to make abstract concepts actionable. Ensure understanding through post-training assessments and knowledge checks. Track and report training completion and results for regulatory compliance and money laundering reporting officer reporting. Effective compliance training is role-specific, interactive, and regularly updated, aligning with actual risks and typologies. It includes assessments and feedback, positioning training as professional development. In contrast, ineffective training is generic, lacks interactivity, and is disconnected from real risks, often seen as a mere obstacle. Training imparts knowledge, but culture ensures its application. Even with perfect policies and systems, failure occurs if compliance is seen as a barrier. A strong compliance culture means everyone, from the board to new recruits, values doing the right thing, even when unobserved. A strong compliance culture is evident in actions, not just words. Leadership visibly supports compliance, ensuring controls aren't bypassed for profit. Psychological safety allows staff to report issues without fear. Mistakes are learning opportunities, not blame games. Compliance is seen as a business enabler, safeguarding the institution's future. Building a strong compliance culture requires consistent communication from leadership about anti-money laundering and counter-terrorism financing importance, recognizing good compliance behavior, and establishing a compliance champions network. Providing feedback on internal suspicious activity reports reinforces the value of speaking up, encouraging ongoing engagement and reporting. Measuring compliance culture involves both quantitative and qualitative indicators. Quantitative metrics include suspicious activity report submission trends, training completion rates, and customer due diligence deficiency rates. Qualitative signals encompass management information quality, staff willingness to challenge, and results from surveys and regulatory visits. Regular assessment ensures a robust compliance culture. The quality of suspicious activity reports directly reflects compliance culture. A strong culture ensures suspicious activity reports are timely and intelligence-rich, while a weak one leads to underreporting or defensive filings. Underreporting creates blind spots, whereas defensive reporting burdens financial intelligence units. Quality reporting arises from trust and understanding, aiding law enforcement effectively. The three pillars of an anti-money laundering, counter-terrorism financing compliance program are interdependent. Excelling in one while neglecting another leaves vulnerabilities. When all pillars are strong and aligned, the institution achieves true resilience against financial crime risk. Module 3 emphasized the interconnected pillars of anti-money laundering, counter-terrorism financing compliance, a risk-based approach, active governance, and essential training and culture. Each pillar is crucial, neglecting one weakens the entire framework. Effective compliance requires identifying risks, active governance, and fostering a culture of understanding and empowerment. This module provides a comprehensive guide to identifying, verifying, and monitoring customers, equipping compliance professionals with essential frameworks to meet regulatory expectations and mitigate financial crime risk. This module further outlines key principles for onboarding clients and assessing corporate structures, ensuring compliance and protection against financial crime. Know your customer is essential for anti-money laundering and counter-terrorism financing programs, ensuring financial institutions verify customer identities and assess risk. Regulatory frameworks like Financial Action Task Force, Bank Secrecy Act, and Financial Crimes Enforcement Network mandate strong Know Your Customer procedures for compliance. This process helps institutions understand customer activities and manage potential risks effectively. Effective Know Your Customer relies on three pillars: the Customer Identification Program, CIP, which sets standards for collecting identifying information, verification of identity, confirming customer identity through various methods, and beneficial ownership, identifying the true owners of a legal entity. Together, these ensure a comprehensive understanding of customer risk. The Customer Identification Program, CIP, requires a board-approved, written plan detailing the collection of key information like full legal name, date of birth or formation, address, and identification number. Verification can occur post-account opening if justified. Records must be kept for 5 years post-closure, adhering to Bank Secrecy Act standards. For individual identity verification, institutions use reliable documents like government-issued photo IDs or national identity cards. These must be unexpired and match the stated identity. Non-documentary methods include credit checks and public database searches. Digital methods, such as electronic Know Your Customer tools and biometric verification, offer equivalent assurance when documents aren't available. Verifying a legal entity's identity involves confirming its existence and control. Key documents include formation documents like articles of incorporation, ownership structures, and authorized representative documentation. Additionally, institutions must verify the registered address and principal business activities to ensure the entity's legitimacy and purpose. Criminals often use complex legal structures to hide true asset ownership. Identifying beneficial ownership is crucial to counter this. Under the Financial Crimes Enforcement Network's rule, a beneficial owner holds 25% plus equity. Institutions must also identify a controlling individual, like a chief executive officer. The Corporate Transparency Act mandates reporting to the Financial Crimes Enforcement Network, enhancing these obligations. To verify beneficial ownership, institutions must collect data on owners with 25% or more equity and identify a senior managing official for control. Verification should use reliable methods, and records must be updated upon material changes or trigger events. Independent corroboration is essential when risk justifies it. Standard Customer Due Diligence, CDD, involves collecting customer information at onboarding, verifying identities through reliable sources, understanding the relationship's nature and purpose, and continuously monitoring activities against the risk profile. This ongoing process ensures compliance and mitigates potential risks throughout the customer lifecycle. In the collection phase of customer due diligence, institutions must gather comprehensive customer information. This includes identity data like name and address, occupation details, and intended products and services. Additionally, understanding the customer's geographic footprint is crucial for assessing risk and ensuring compliance with regulatory standards. Understanding the nature and purpose of a business relationship is crucial in customer due diligence. Establish the account's purpose, transaction expectations, and sources of funds and wealth. Use customer forms, manager notes, and supporting documents. Without this baseline, transaction monitoring lacks a benchmark, reducing anomaly detection effectiveness. Ongoing monitoring is crucial for detecting changes in customer behavior and updating risk profiles. It involves transaction monitoring to spot inconsistencies, periodic reviews to ensure data accuracy, and trigger-based reviews for specific events like suspicious activity reports or changes in ownership. This ensures the relationship remains commercially viable and compliant. The frequency of periodic reviews should match the customer's risk level. Low-risk clients are reviewed every 3 to 5 years, focusing on identity and address updates. Medium-risk clients, reviewed every 1 to 2 years, require checks on funds and ownership changes. High-risk clients need annual reviews, including full enhanced due diligence refresh and senior approval. Trigger events prompt immediate reviews. Maintaining complete and accurate customer due diligence records is a legal obligation. Institutions must retain identity documents, verification records, risk assessments, monitoring alerts, and review outcomes for at least 5 years after account closure or the last transaction. Records should be easily retrievable, with digital backups protected against unauthorized changes. Enhanced Due Diligence, EDD, is the highest level of scrutiny in the customer due diligence framework, mandatory for high-risk scenarios like money laundering or terrorist financing. Financial Action Task Force Recommendation 19 and Financial Crimes Enforcement Network's Customer Due Diligence Rule require enhanced due diligence for high-risk customers, politically exposed persons, and correspondent banking relationships. Enhanced due diligence is required when a risk-based assessment identifies heightened financial crime risk. Common triggers include high-risk customers, transactions, or relationships. Statutory and regulatory guidelines mandate enhanced due diligence in these scenarios to mitigate potential threats. Identifying high-risk customers requires analysts to use judgment beyond policy. Cash-intensive businesses, unexplained wealth, adverse media, and prior suspicious activity reports are key triggers for enhanced scrutiny. These factors help determine if a customer warrants elevated risk assessment. Geographic risk is crucial in anti-money laundering and counter-terrorism financing assessments. Transactions with countries having weak anti-money laundering regimes or sanctions exposure need extra scrutiny. Key lists include Financial Action Task Force Black and Grey lists, Office of Foreign Assets Control sanctions, and European Union high-risk third countries. Always assess both the customer's residence and fund flow jurisdictions and document your rationale for engaging with high-risk areas. Complex and opaque structures are red flags for money laundering. Shell companies lack operations and are used for anonymous fund transfers. Nominee arrangements obscure true ownership. Multi-jurisdictional chains complicate tracing beneficial owners. Discretionary trusts add uncertainty by allowing trustees to alter beneficiaries. Enhanced due diligence, EDD, requires institutions to gather extensive information beyond standard customer due diligence, CDD. This involves deep research using adverse media, registries, and financials, enhanced monitoring, senior management approval, and verifying the source of funds and wealth. Thorough documentation of each measure and its rationale is crucial for regulatory scrutiny. Verify the source of funds with documentary evidence like bank statements or sale agreements. Assess the source of wealth through employment history or investments, corroborated independently. Conduct enhanced adverse media screening across global sources. Ensure senior management, such as head of compliance, approves high-risk relationships. An effective enhanced due diligence file must include identity verification, source of funds evidence, and adverse media search outcomes. It should also contain a risk assessment narrative and senior management approval. Common failures include relying on unverified self-declarations and missing identity documents. Ensure all records have clear outcomes and formal approval with an audit trail. Politically exposed persons, PEPs, are high risk in anti-money laundering due to their public trust roles, making them prone to corruption. Foreign politically exposed persons include heads of state and senior officials abroad. Domestic politically exposed persons are similar but within the same country. Close associates and family members can act as proxies for asset movement. Politically exposed person screening involves several key steps. Initially, screen new customers against politically exposed person databases and media sources. Classify politically exposed persons by role and jurisdiction, then secure senior management approval. Apply enhanced due diligence, verifying sources of funds and maintaining ongoing monitoring, even after the individual leaves their position, for at least 12 to 18 months. PEP screening requires a layered approach. Use commercial databases like WorldCheck and LexisNexis, alongside sanctions lists such as Office of Foreign Assets Control and European Union Consolidated List. Conduct adverse media searches and consult government records for comprehensive coverage and to minimize false negatives. Monitoring politically exposed person relationships requires ongoing vigilance. Enhanced transaction monitoring with lower alert thresholds is crucial. Annual enhanced due diligence reviews, including rescreening and risk assessment, are mandatory. If unexplained activities arise or risk exceeds tolerance, exiting the relationship is necessary, but suspicious activity report obligations remain if suspicion persists. Each year, approximately $3.1 trillion is laundered globally, representing 2 to 5% of global GDP. Over $3 billion in penalties have been issued by United States regulators due to CDD and EDD failures. Notably, 40% of high-profile money laundering cases involve PEPs. A minimum of 18 months of post-exit monitoring is recommended for PEPs. Simplified due diligence (SDD) involves reduced customer scrutiny when the risk of money laundering or terrorist financing is genuinely low. It is a risk-based calibration of customer due diligence (CDD) measures, not an exemption. Institutions must still identify and verify customers, applying fewer measures based on a documented low-risk assessment. Simplified due diligence is permitted when a customer, product, or service is assessed as low risk for money laundering or terrorist financing. This includes regulated financial institutions, public authorities, listed companies, and low-risk products. The assessment must be documented and regularly reviewed to ensure compliance. Simplified due diligence is conditional and subject to strict limitations. It requires a documented low-risk assessment and periodic reviews. Simplified due diligence cannot apply to politically exposed persons or sanctioned individuals, nor override suspicious activity report obligations. Changes in risk profile necessitate escalation to standard customer due diligence or enhanced due diligence. Always verify local regulatory requirements. The customer due diligence risk spectrum illustrates that simplified due diligence, standard customer due diligence, and enhanced due diligence are interconnected, forming a continuous risk spectrum. Customer positions on this spectrum should adapt to new information, trigger events, and periodic reviews. Regular updates are essential, especially when there's a material change in information, behavior, or the external risk environment. Let's compare CDD, EDD, and SDD. SDD involves low risk with simplified identity verification and reduced beneficial ownership checks. Standard CDD requires full verification and a 25% ownership threshold. EDD, for high-risk scenarios, demands corroborated identity checks, in-depth ownership verification, documented source of funds, mandatory senior approval, and enhanced transaction monitoring. Understanding common customer due diligence and enhanced due diligence failures is crucial. Incomplete customer files often lack verified identity documents. Institutions frequently fail to identify beneficial owners, relying on self-declarations. Risk ratings can be outdated or formulaic. Additionally, gaps in politically exposed person screening expose institutions to unacceptable risks. Addressing these deficiencies helps prevent regulatory issues. Analysts must recognize red flags that trigger escalation. Inconsistent information, unusual transaction patterns, reluctance to provide information, unexpected geographic exposure, and complex structures are key indicators. These require investigation and judgment, as they don't confirm money laundering alone but highlight potential risks needing further scrutiny. The customer due diligence decision framework involves an initial risk assessment based on customer type, geography, products, and activity. It includes ongoing monitoring with periodic reviews and trigger-based updates. Assign customer due diligence tiers, simplify due diligence for low risk, standard for medium, and enhanced due diligence for high risk or politically exposed persons. This framework ensures systematic, documented outcomes. Effective customer due diligence and enhanced due diligence require clear roles across the three lines of defense. The first line, business and relationship managers, handle customer information and flag unusual activity. The second line, compliance and risk functions, set policies and review high-risk files. The third line, internal audit, ensures processes are effective and policies are followed. In conclusion, KYC is foundational, CDD is ongoing, and risk dictates proportionality. Documentation is crucial. If it's not recorded, it didn't happen. These principles are vital for compliance. This module equips you with the skills to identify, escalate, and report suspicious financial activities effectively. We'll explore why monitoring is crucial in combating money laundering and terrorist financing. Financial institutions must act as vigilant gatekeepers, as failure to do so can lead to severe penalties, including fines and criminal charges. This module covers monitoring systems, red flag identification, reporting obligations, and record-keeping requirements. A robust transaction monitoring program is essential for effective anti-money laundering and counter-terrorism financing frameworks. Institutions must use automated systems with rule-based engines and machine learning models alongside manual reviews by human analysts. Red flag scenarios and structured escalation procedures ensure comprehensive detection and reporting of suspicious activities. Automated monitoring processes hide transaction volumes quickly, using rule-based scenarios and AI models to detect anomalies. It requires regular calibration to reduce false positives. Manual monitoring, essential for complex cases, relies on staff expertise and captures nuances algorithms might miss. Combining both methods ensures comprehensive compliance with regulatory standards. Developing red flag indicators involves translating money laundering typologies into monitoring rules tailored to your institution's risk profile. Identify typologies using Financial Action Task Force guidance and internal suspicious activity report history. Convert these into measurable parameters, test against historical data, and adjust thresholds. Review scenarios annually or when risks change to ensure relevance. An alert initiates an investigation, not a conclusion. Each alert undergoes a Level 1 review by an analyst, followed by Level 2 escalation if unresolved. The Money Laundering Reporting Officer decides on filing a suspicious activity report, suspicious transaction report, or closing the alert with documented rationale. Timely completion and thorough documentation are crucial for regulatory scrutiny. Suspicion in transactions arises when activities deviate from expected norms. Key indicators include unusual transaction patterns, evasive customer behavior, and sector-specific risks. Documenting these suspicions with clear, factual records is crucial for defensible suspicious activity reports, suspicious transaction report filings, and regulatory scrutiny. Retail banking poses significant money laundering risks due to direct payment system access. Key indicators include structuring with deposits below reporting thresholds, rapid fund movements, third-party deposits, sudden dormant account activity, inconsistent transaction profiles, and frequent transfers involving high-risk jurisdictions. Monitoring these red flags is crucial for identifying suspicious activities. Insurance products, especially life insurance, can be exploited for money laundering. Key red flags include early policy cancellation for clean payouts, premium overpayments for refunds, and third-party premium payments without clear relationships. Frequent changes in beneficiaries, especially in high-value policies, may indicate illicit activities. In securities and capital markets, suspicious activities include round-trip trades with minimal profit, inconsistent trading patterns, and heavy trading in illiquid securities. Watch for clients reluctant to disclose fund sources, third-party account funding, and frequent cash-like transfers. These actions often involve offshore accounts and shell entities to hide beneficial ownership. Real estate is a high-risk sector for money laundering. Key red flags include all-cash purchases by new entities, complex ownership structures using shell companies, price manipulation through unusual valuations, and unclear sources of funds, especially from high-risk jurisdictions. These factors facilitate the integration of illicit funds into legitimate markets. Behavioral indicators can reveal suspicious intent. Evasiveness in answering questions, unusual urgency to bypass procedures, and knowledge of reporting thresholds are key signs. Additionally, inconsistencies with a customer's Know Your Customer profile, such as lifestyle or transaction patterns, should raise red flags. Frontline staff must document these observations diligently. Documenting suspicion is crucial. Record specific transactions, dates, and customer explanations. Include staff assessments and cross-references. Ensure documentation is factual, timely, objective, complete, and secure. This prevents regulatory issues and aids in prosecution. When suspicion remains unresolved, institutions must file a suspicious activity report, suspicious transaction report with the Financial Intelligence Unit. This report is confidential and mandatory, regardless of transaction size or crime confirmation. Internally, report to the Money Laundering Reporting Officer with documentation. The Money Laundering Reporting Officer then submits to the Financial Intelligence Unit within legal timeframes. Never inform the subject of the report, it's a criminal offense. The Suspicious Activity Report, SAR, or Suspicious Transaction Report, STR, is crucial in combating money laundering and terrorist financing. It provides financial intelligence for investigations, creates an audit trail, and may lead to asset freezing. Filing is based on suspicion, not proof, ensuring compliance and legal protection for reporting staff. Internal reporting procedures require staff to report suspicions promptly without investigating or alerting customers. The process involves submitting an internal suspicious activity report, ISAR, to the Money Laundering Reporting Officer, MLRO, who reviews and decides on external filing. This ensures consistent and defensible decision-making within the compliance structure. An internal suspicious activity report, ISAR, must include reporter details, such as name and department, customer information like account numbers and know your customer data, a factual description of the suspicious activity, and supporting evidence like transaction records. This ensures the Money Laundering Reporting Officer can make an informed decision. Once the Money Laundering Reporting Officer decides to file a Suspicious Activity Report, Suspicious Transaction Report, it must be submitted to the National Financial Intelligence Unit. Use the prescribed form or portal, file within deadlines, and ensure completeness. Retain copies, log details, and await Financial Intelligence Unit guidance. Maintain discretion to avoid alerting the subject. The tipping-off prohibition makes it a criminal offence to disclose a suspicious activity report, suspicious transaction report to the subject or third parties. This includes directly informing the customer, altering account behaviour, or sharing information with outsiders. Permitted disclosures are limited to within the financial group or to regulators, with legal guidance advised to avoid breaches. Avoid common suspicious activity report, suspicious transaction report filing errors to strengthen anti-money laundering frameworks. Delayed filings undermine intelligence value and may breach regulations. Narratives should link facts to typologies, not just restate data. Missing documentation reduces Financial Intelligence Unit effectiveness. Defensive filings without genuine suspicion waste resources and attract regulatory criticism. Comprehensive record keeping is crucial for anti-money laundering and counter-terrorism financing compliance. Maintain records on customer identification, due diligence, and transactions. Retain these for at least 5 years as per national law. Ensure secure storage and access only for authorized personnel. Be audit ready by having complete records available promptly for regulatory or law enforcement requests. Anti-money laundering, counter-terrorism financing record keeping is crucial throughout the customer life cycle. Maintain complete and accurate records, including customer due diligence documents like passports and ownership declarations. Transaction records must detail amounts, dates, and purposes. Monitoring records should include alert logs and suspicious activity report decisions. Training records must show staff training details, ensuring compliance and readiness for audits. Retention periods are legally mandated minimums. Institutions must retain customer identification, transaction, and suspicious activity report records for at least 5 years. This period starts at the end of the business relationship or transaction date. Extensions may apply in jurisdictions aligned with Financial Action Task Force recommendations, especially for ongoing investigations. Always verify local requirements. Ensuring record integrity, security, and accessibility is crucial. Records, whether physical or electronic, must remain complete and unaltered. Electronic records require secure, tamper-evident systems with audit trails. Access is restricted to authorized personnel, and retrieval systems must allow efficient searching. A designated custodian ensures accountability and compliance with regulatory requests. In summary, continuous transaction monitoring, prompt documentation of suspicions, timely reporting, maintaining confidentiality, and complete record keeping are essential for compliance. These principles are non-negotiable and apply across all roles and business lines to ensure effective anti-money laundering and counter-terrorism financing practices. This module will equip anti-money laundering and compliance professionals with the knowledge to tackle evolving financial crime threats, including virtual assets, cybercrime, and AI-driven detection. The rise of digital payment methods, including blockchain assets and embedded finance platforms, has transformed financial crime risks. Compliance teams must grasp how these innovations introduce both opportunities and vulnerabilities within the anti-money laundering framework, necessitating updated strategies to effectively manage emerging threats. Virtual assets present unique anti-money laundering challenges. Their pseudonymity allows evasion of know-your-customer controls, especially on decentralized exchanges. Transactions are fast and irreversible, complicating fund recovery. Cryptocurrency's cross-border nature bypasses traditional anti-money laundering friction. Privacy coins and mixers further obscure audit trails, making it difficult to trace ownership. Global regulators are integrating VASPs into AML frameworks. The FAFSA Recommendation 15 mandates AML/CTF obligations for VASPs, requiring registration and compliance with CDD and transaction monitoring. The travel rule demands transmission of transaction details, while risk-based supervision in the European Union, United Kingdom, and United States tailors controls to specific risks. Key virtual asset typologies include placement, layering, integration, and extraction. Illicit actors exploit these stages, from cash to crypto conversions to using stablecoins for integration. Understanding these methods is crucial for developing effective transaction monitoring and due diligence programs for virtual asset service providers. Financial technology innovations have democratized financial services, but also introduced new financial crime vectors. Neobanks and digital wallets face risks like synthetic identity fraud. Embedded finance platforms may lack anti-money laundering infrastructure. By now, pay later services risk fraudulent account creation. Open banking application programming interfaces increase account takeover risks, highlighting anti-money laundering challenges at integration layers. Regulators emphasize that fintechs must adhere to anti-money laundering obligations like traditional institutions. Key requirements include customer due diligence, transaction monitoring, suspicious activity reporting, and sanction screening. Common compliance gaps involve over-reliance on automation, insufficient typology libraries, weak governance, and inadequate suspicious activity report resourcing. Peer-to-peer lending and crowdfunding platforms face unique anti-money laundering challenges. Without traditional intermediaries, they may lack essential anti-money laundering infrastructure. Beneficial ownership gaps can obscure true ownership, necessitating robust customer due diligence. Additionally, crowdfunding can be misused for illicit fundraising, including terrorist financing, under the guise of legitimate campaigns. Cybercrime is a major source of illicit funds worldwide. Anti-money laundering professionals must understand how cyber-enabled crime integrates with money laundering processes. This knowledge is crucial beyond just information security, as it directly impacts the effectiveness of anti-money laundering strategies. Cyber-enabled financial crime merges the lines between the crime itself and money laundering. The digital infrastructure facilitates both the crime and the rapid movement of illicit proceeds, making detection and prevention challenging. Cyber-enabled crime typologies include ransomware, where systems are encrypted for cryptocurrency ransom, laundered through mixers and non-compliant virtual asset service providers. Business email compromise involves impersonation to redirect payments, quickly moved through mule accounts. Account takeover fraud exploits compromise credentials, necessitating real-time monitoring. Dark web marketplaces facilitate laundering through privacy tools and weak anti-money laundering jurisdictions. Financial mules are essential in cyber-enabled money laundering, acting as a human buffer. They convert traceable transfers into cash or cryptocurrency. Mules are recruited via social media or scams, often unknowingly. Fraud proceeds enter mule accounts, are quickly extracted and reintegrated into the economy through purchases or property acquisition. Rapid fund movement, inconsistent behavior, multiple small inflows, and crypto conversion are key red flags in cyber-enabled money laundering. These patterns indicate suspicious activity, such as immediate fund transfers, transactions misaligned with customer profiles, structured mule activity, and conversion to virtual assets through exchanges with weak know-your-customer controls. Anti-money laundering compliance involves handling sensitive data, creating tension with data protection laws. Key frameworks include General Data Protection Regulation, California Consumer Privacy Act, and sector-specific rules. Challenges include suspicious activity report tipping-off restrictions, cross-border data transfer safeguards, and balancing data retention with minimization. Cybersecurity breaches pose regulatory and reputational risks. Tipping off is a critical principle in anti-money laundering compliance. Once a suspicious activity report is filed, disclosing this to the subject or third parties is prohibited and considered a criminal offense. Staff must maintain normal interactions with customers during investigations unless directed otherwise by law enforcement. Trade-based money laundering, TBML, leverages the complexity of international trade to obscure illicit funds. It's a major, yet underdetected, method of laundering responsible for billions in illicit flows annually. Understanding trade-based money laundering is crucial for combating global financial crime. Trade-based money laundering, TBML, manipulates trade documents and goods movement to obscure value transfers. It exploits trade finance opacity and customs limitations. Techniques include over-under invoicing, falsely described goods, and multiple invoicing. Effective detection demands collaboration among financial institutions, trade finance teams, and customs authorities. Over-under invoicing involves manipulating invoice values to transfer funds across borders under the guise of trade. Multiple invoicing generates multiple payments for a single shipment. Falsely described goods misrepresent trade details to facilitate improper payments. The black market peso exchange converts illicit United States dollars into local currency through trade, originating in Latin America. Identifying trade-based money laundering involves recognizing pricing anomalies, inconsistent documentation, unusual trade routes, counterparty concerns, and payments via third parties. These indicators necessitate enhanced due diligence, as they often signal potential trade-based money laundering activities. Trade-based money laundering, TBML, is a significant global issue with over $2 trillion in annual illicit trade. An estimated 80% of illicit financial flows from developing countries involve trade misinvoicing. Over 150 jurisdictions face material TBML risk, highlighting the need for robust anti-money laundering controls and collaboration with customs and border authorities. Banks and trade finance providers play a crucial role in detecting trade-based money laundering. They must screen trade documents, conduct due diligence, and apply enhanced scrutiny to high-risk transactions. Collaboration with customs and financial intelligence units is vital. Aligning with guidance from the Wolfsburg Group, International Chamber of Commerce, and Financial Action Task Force ensures effective anti-money laundering controls. Proliferation financing involves funding the development, acquisition, or transfer of weapons of mass destruction. It poses a significant threat within the anti-money laundering/counter-financing of terrorism framework. Historically, it has been overshadowed by terrorist financing, but this is now changing as awareness increases. Proliferation financing involves funding the development or acquisition of nuclear, biological, chemical, and radiological weapons by sanctioned entities. It includes financing dual-use goods, providing services to sanctioned proliferators, and facilitating controlled technology transfers. Examples of dual-use goods are high-strength aluminum alloys for nuclear centrifuges and precision machine tools for missile components. Proliferation financing and terrorist financing differ in actors, scale, methods, and regulations. Terrorist financing involves non-state groups with small funds, often from donations. Proliferation financing involves state actors, large funds, and illicit trade. Regulatory tools include counterterrorism financing laws for terrorist financing and United Nations sanctions for proliferation financing. Detection focuses on transaction patterns for terrorism and sanctions screening for proliferation. Proliferation financing involves sophisticated networks using front companies and intermediaries to evade export controls and sanctions. State-sponsored actors exploit these systems across jurisdictions, ensuring sustained procurement and financial concealment. Their strategic patience and infrastructure development are key to their operations. Proliferation financing red flags include connections to United Nations designated proliferators, transactions involving dual-use goods with vague end uses, complex ownership structures obscuring beneficial owners, and transshipment patterns lacking commercial rationale. These indicators suggest potential sanctions evasion and require careful scrutiny. The international framework to combat proliferation financing has evolved significantly. The United Nations Security Council mandates financial sanctions against proliferating states. Financial Action Task Force Recommendation 7 requires immediate implementation of targeted financial sanctions. Export controls by multilateral regimes complement these efforts. National authorities like the Office of Foreign Assets Control and the Office of Financial Sanctions Implementation enforce sanctions, necessitating institutions to screen against multiple lists. Financial institutions must adopt a risk-based approach to proliferation financing. This involves real-time sanctions screening, enhanced due diligence for high-risk jurisdictions, awareness of dual-use goods, and staff training on proliferation financing typologies. Financial Action Task Force's guidance emphasizes assessing proliferation financing risk across customers, products, and geography, ensuring controls match the risk level. Artificial intelligence and machine learning are revolutionizing anti-money laundering compliance. These technologies offer unprecedented capabilities, but also pose complex governance challenges. It's crucial for compliance professionals to grasp both the potential and limitations of these tools in today's regulatory landscape. Traditional anti-money laundering systems struggle with high false positive rates, estimated at 95%, overwhelming analysts. The global annual cost of anti-money laundering compliance is $300 billion, largely due to manual processes. Alarmingly, only 1% of illicit funds are seized, underscoring the need for more effective detection methods. Artificial intelligence and machine learning revolutionize anti-money laundering monitoring by enhancing anomaly detection, network analysis, and natural language processing. Machine learning models identify deviations from customer behavior, uncover hidden criminal networks, and automate narrative data review, significantly improving the efficiency and effectiveness of anti-money laundering compliance processes. Artificial intelligence transforms anti-money laundering with dynamic customer risk scoring, continuously updating risk profiles. In transaction monitoring, machine learning models enhance detection accuracy, reducing false positives. For suspicious activity report decision support, artificial intelligence analyzes context and patterns, improving filing consistency. In sanction screening, machine learning reduces false positives from name variations, addressing traditional system challenges. Artificial intelligence-powered anti-money laundering programs integrate machine learning throughout the compliance lifecycle. From onboarding with machine learning risk scoring and identification verification to ongoing customer due diligence with dynamic profiling, artificial intelligence enhances transaction monitoring through anomaly detection and network analysis. Alert management benefits from artificial intelligence-assisted triage, reducing false positives, while suspicious activity report filing is supported by natural language processing narratives and decision support. Artificial intelligence in anti-money laundering faces governance and ethical challenges, particularly in explainability and bias. Complex models may outperform simpler ones, but lack transparency, complicating suspicious activity report narratives and fair treatment. Additionally, machine learning models can perpetuate biases, necessitating regular bias testing and independent validation to ensure fairness and model integrity. Regulators are setting clear expectations for artificial intelligence in anti-money laundering compliance. Independent model validation is crucial, ensuring soundness and performance. Human oversight remains essential, with artificial intelligence supporting, not replacing, compliance professionals. Institutions must document artificial intelligence processes for auditability and ensure fairness, avoiding discriminatory outcomes in customer treatment decisions. AI is revolutionizing financial crime compliance. Federated learning allows institutions to train shared models while preserving privacy. AI systems enable real-time risk assessment, enhancing transaction security. Generative AI automates regulatory reporting, easing administrative tasks. Adaptive controls shift compliance from reactive to proactive, updating in response to new criminal behaviors. Welcome to our discussion on AI and ML, challenges versus opportunities. We'll explore the dynamic landscape of artificial intelligence and machine learning, focusing on the hurdles and potential these technologies present. Choosing the right AI tools for anti-money laundering requires a structured evaluation framework. Define the problem, assess data readiness, evaluate explainability, and plan governance. Ensure the AI solution addresses specific anti-money laundering gaps. Data quality is audited, outputs are explainable, and governance is established before implementation. Artificial intelligence enhances anti-money laundering professionals by processing vast transactions, detecting anomalies, and monitoring intelligence continuously. Humans excel in applying judgment, building intelligence relationships, and navigating ethical dimensions. Together, they form a powerful partnership, combining machine efficiency with human expertise for effective financial crime compliance. Today's financial crime threats converge across multiple risk categories. Examples include crypto-enabled trade-based money laundering, cyber-enabled fraud through financial technology, and artificial intelligence-generated deepfakes for business email compromise. Compliance programs must adapt to these complex intersections. Building a future-ready anti-money laundering program requires investment in technology, talent, and intelligence. Strong foundations like customer due diligence and transaction monitoring are essential. Prioritize data quality and governance for effective artificial intelligence deployment. Adopt artificial intelligence/machine learning tools for tasks like alert triage. Shift to proactive, intelligence-led risk management through research and collaboration. The regulatory landscape for anti-money laundering is rapidly evolving. Key areas include virtual asset regulation with European Union markets in crypto assets and Financial Action Task Force scrutiny. Artificial intelligence governance under the European Union Artificial Intelligence Act and beneficial ownership transparency. Additionally, the European Union's Anti-Money Laundering Authority will enhance cross-border compliance from 2025, setting higher standards for high-risk entities. In summary, we have explored key anti-money laundering challenges: crypto's high-risk nature, cybercrime's laundering methods, trade-based money laundering's trade misinvoicing, and the distinct nature of proliferation financing. Artificial intelligence's role in anti-money laundering was highlighted, emphasizing governance and oversight. These insights are crucial for real-world application. For further reading, consult these key resources: Financial Action Task Force's guidance on virtual assets and proliferation financing, Wolfsburg Group's Trade Finance Principles, and Egmont Group's Cybercrime publications. Regulatory guidance includes Financial Crimes Enforcement Network's advisories, Financial Conduct Authority's Crypto-ASIC guidance, and European Banking Authority's money laundering/terrorist financing risk factors. Stay informed with Interpol's threat assessments and Global Financial Integrities reports. Module 7 connects theory with practice by exploring real-world enforcement actions and engaging in hands-on scenarios. Analyzing real-world money laundering and terrorist financing cases highlights institutional failures and regulatory expectations. Enforcement actions by bodies like the Financial Crimes Enforcement Network and the Financial Conduct Authority reveal systemic weaknesses. Lessons learned include inadequate customer due diligence and weak transaction monitoring. Understanding these failures helps compliance professionals strengthen anti-money laundering, counterterrorism financing frameworks to prevent future breaches. Let's examine high-profile anti-money laundering, counterterrorism financing enforcement actions. HSBC's $1.9 billion settlement in 2012 revealed severe anti-money laundering control deficiencies. Danske Bank's €200 billion scandal highlighted ignored whistleblower warnings. Wachovia's $160 million penalty in 2010 exposed failures in handling bulk cash and cross-border transactions. These cases underscore the importance of robust anti-money laundering frameworks. Anti-money laundering and counterterrorism financing enforcement spans various sectors, as seen in landmark cases. One Malaysia development Berhad involved for $0.5 billion misappropriated via shell companies, highlighting bond issuance risks. Westpac's Australian $1.3 billion fine for failing to report fund transfers linked to exploitation networks led to an anti-money laundering overhaul. Banque Nationale de Paris Paribas faced an $8.9 billion settlement for violating United States sanctions, showing anti-money laundering and sanctions compliance intersection. Major enforcement actions reveal recurring failures in anti-money laundering, counterterrorism financing controls. Weak governance culture leads to resource deficiencies, undermining transaction monitoring and customer due diligence quality. Addressing root causes, not just symptoms, is crucial for a resilient program. Enforcement outcomes highlight key compliance expectations. A risk-based approach ensures resources match actual risks. Adequate skilled resources are crucial. Under-resourcing is an aggravating factor. Effective internal controls require independent audits. Clear escalation pathways ensure concerns reach the money laundering reporting officer and relevant authorities without obstruction. These principles are essential for a robust anti-money laundering and counterterrorism financing framework. Non-compliance with anti-money laundering and counterterrorism financing regulations can have devastating consequences beyond financial penalties. BNP Paribas faced an $8.9 billion fine, HSBC a $1.9 billion settlement, and Danske Bank had €200 billion in suspicious transactions. Westpac's failure to report 19.5 million transfers led to Australia's largest corporate fine. Reputational damage and potential criminal liability are also significant risks. Welcome to Module 7.2, Interactive Scenarios and Workshops. This section emphasizes practical skills in risk identification and response through structured workshops. Participants will engage in scenario-based exercises, applying customer due diligence and enhanced due diligence, identifying transaction red flags, and drafting mock suspicious activity reports. In this workshop, participants will act as compliance analysts, reviewing complex customer profiles like politically exposed persons and shell companies. They'll determine due diligence levels, identify information gaps, and document risk assessments. Key learning outcomes include distinguishing customer due diligence types, applying beneficial ownership tracing, and understanding wealth and funds verification. In a risk-based approach, due diligence measures must be tailored to the customer's risk level. Elevated risks demand rigorous checks, while low risks require proportionate measures. Risk classification is dynamic, necessitating ongoing monitoring and reviews when circumstances change, such as business activity shifts or adverse media exposure. Read the following profile carefully. Determine the appropriate due diligence level, identify missing information, and document your risk assessment rationale. The risk classification for Meridian Holdings Limited is enhanced due diligence, EDD, due to high-risk factors. These include Mr. Alexei Volkov's nationality from a high-risk jurisdiction, incorporation in the British Virgin Islands, politically exposed person association, and lack of source of wealth documentation. The substantial transaction volume and unregulated introducer further necessitate enhanced due diligence under anti-money laundering regulations. To proceed with onboarding, we need full corporate documentation for Meridian Holdings Limited, including proof of address and director verification. For Mr. Volkov, certified identity documents and proof of address are required. Comprehensive source of wealth and funds documentation is critical, alongside a detailed business plan for property investments in Western Europe. Introducer due diligence involves assessing the unregulated estate agent's business and their connection to Mr. Volkov. Enhanced screening includes adverse media and sanctions checks on Mr. Volkov, Meridian Holdings Limited, and the senior government minister. Additionally, understanding the rationale for British Virgin Islands incorporation is crucial for evaluating the commercial strategy. Effective transaction monitoring requires analytical judgment beyond automated systems. Key red flags include structuring, rapid fund movement, inconsistency with customer profiles, and unexplained third-party payments. Contextual assessment is crucial to distinguish legitimate activity from potential money laundering or terrorist financing. Familiarity with typologies from the Financial Action Task Force, Egmont Group, and financial intelligence units is crucial for compliance professionals. Key red flags include the use of shell companies, cash-intensive businesses, cryptocurrency typologies, and trade-based money laundering. These patterns often obscure true ownership and disguise illicit financial flows, demanding vigilant monitoring and analysis. Workshop B. Transaction Analysis Exercise. Review the transaction data extract below. Identify all red flags present, assess their cumulative significance, and determine whether a suspicious activity report should be filed. What reporting threshold is being deliberately avoided? What does the rapid onward transmission suggest about the placement, layering, and integration stages? Document your conclusions. Repeated cash deposits just below £10,000 suggest structuring to avoid detection. Using multiple branches quickly as a tactic to evade attention, indicating placement stage money laundering. Rapid fund transfers to British Virgin Islands and United Arab Emirates, both high-risk jurisdictions, highlight layering, as funds are moved swiftly to obscure origins and counterparties. High-risk jurisdictions like British Virgin Islands and United Arab Emirates can obscure ownership and audit trails. Vague transaction descriptions, such as your consultancy, lack business rationale and documentation, raising red flags for money laundering. Additionally, cash deposits into phone account without business operations suggest no legitimate activity, indicating potential layering and integration issues. The cumulative significance of these behaviors illustrates a classic money laundering scheme across all stages: placement, layering, and integration. The deliberate pattern includes sub-threshold cash deposits, rapid international transfers, and payments disguised as consultancy. Filing a suspicious activity report is essential due to structuring, high-risk jurisdictions, and lack of legitimate purpose. Understanding the 3 stages of money laundering is crucial for effective detection. Stage 1, placement, involves introducing illicit funds into the financial system with red flags like structured deposits. Stage 2, layering, distances funds through complex transactions. Stage 3, integration, reintroduces cleaned funds into the economy, often through high-value purchases. Filing a suspicious activity report or suspicious transaction report is crucial for compliance, requiring action when suspicion arises, not proof. Delaying is a compliance failure. Disclosing a suspicious activity report's existence is tipping off a criminal offence. Good faith reporting offers legal protection, and understanding that the consent regime is essential for staff. An effective suspicious activity report must be factual, concise, and comprehensive. Include subject information like full name and account details. Clearly state grounds for suspicion with specific transactions and inconsistencies. Detailed transaction specifics, actions taken, and attach supporting documentation. This ensures investigators have the full context to act effectively. Draft a mock suspicious activity report using previous workshop scenarios. Focus on factual, objective narratives without personal conclusions. Ensure all identifying information is included and transaction timelines are clear. Write plainly, referencing specific details, and avoid speculation or emotive language. Consider the consent regime where applicable. Meridian Holdings Limited, incorporated in the British Virgin Islands, is linked to suspicious activities. The beneficial owner, Mr. Alexei Volkov, lacks wealth documentation and has politically exposed person risk due to family ties. Cash deposits just below £10,000 were made at different branches, followed by international transfers to British Virgin Islands and United Arab Emirates, raising suspicion of illicit fund movement. The activity contradicts the stated purpose of property investment, with cash deposits just below reporting thresholds and rapid transfers to high-risk jurisdictions. Risk factors include incorporation in the British Virgin Islands, lack of wealth documentation, and politically exposed person connections. These suggest potential money laundering through placement and layering of illicit funds. Transaction timeline must be included in the SAR report. Additional information can also be included in the report. Financial Intelligence Unit feedback highlights common suspicious activity report drafting errors. Vague narratives lack specifics, reducing intelligence value. Ensure narratives detail observations, inconsistencies, and suspected offences. Include complete subject data, even if uncertain. Delayed filing is a compliance failure. Report upon suspicion. Use the consent regime when transactions are suspicious but not executed to avoid liability. Module 7 emphasizes bridging knowledge with action. Learn from past enforcement failures, apply risk-based thinking, and ensure timely suspicious activity reporting. Remember, compliance is a collective responsibility across all levels of an institution.